if you're bullish on gold, Donald Trump's your best friend.
We are now at a time in history where hard truths are being learned.
The United States at $38 trillion of debt, which is an obscene amount and growing.
Gold at $5,000 is a bright neon sign saying...
Welcome back to the Vancouver Resource Investment Conference.
Quite a few people raised their hands saying that they feel the economy is weak. Recently, we had some strong GDP numbers come out of the United States. President Trump touted the numbers and such. And so, what is this dichotomy here where the people feel that the economy is weak and you're getting data that's coming out that's saying that the economy is strong? And so, let's start with you, Dr. Nomi.
First of all, thank you so much for being here this afternoon. So the economy really depends on who you're talking for, right? Who is it good for? The 5.4% GDP number that the Atlanta Fed has been touting around, 5.3, 5.4, indicates a growth level that's actually higher than it really is. And it also doesn't talk about the labor environment, which at this point at 4.4% unemployment is actually worse than it was before COVID. But that doesn't get talked about. We also have a Federal Reserve who is in between reducing rates to basically stimulate the banking system, which is facing at this moment record loan delinquencies, or at least record since the 2008 financial crisis period, and growing. And we have debt overhang, well, the United States at $38 trillion of debt, which is an obscene amount and growing. And we also have the fact that on the side of consumer debt, not much better. We're at record levels of consumer debt. So if you combine all of the weaknesses and the over leverage that is in the economy relative to the figures on the economy, that really indicates there's a tremendous gap. And that's why people feel it's a lot weaker, because it is a lot weaker than the top line 5.4% growth numbers indicate.
Okay, thank you. So David, you had some recent thoughts on this and comments on these GDP numbers. So just curious in your perspective on, this strong economy that's been touted.
Well, I think the first point I would make is that GDP is just one statistic. And when I started in the business in the mid-1980s, we weren't laser focused just on GDP. GDP is all about spending, okay? But it doesn't tell you about income. And there is a huge gap right now in the national accounts data between what incomes are doing and what spending is doing. But because we're also narcissistic, we just focus on the spending side. Let me just say that in the past 3 quarters in the United States, we've had no growth in aggregate hours worked, which means that when you look at employment and you look at the hours that people are putting in to the economy, there has been zero growth in labor input into the economy for 3 quarters. On top of that, real after-tax income, real disposable income in the United States since April is running at minus 1% at an annual rate. And lo and behold, GDP, which is spending, is running plus 3.5%. So we have this huge dichotomy between incomes. If we're talking about real personal disposable income, believe it or not, we're actually in a recession in the United States. And if you look at the GDP numbers, you think we're in some sort of a boom. And so let me just try and square the circle here as to what's happening with these GDP numbers. What is juicing GDP are 2 things. The first is that because of the Trump trade war on the world, US imports are sliding. And when you look at GDP is consumer spending plus business investment plus housing plus exports minus imports. So when imports go down, this is for every country, GDP goes up. Declining imports is an addition. So when people talk to me about the beloved GDP numbers, I tell them, do you know that the strongest component of GDP growth is the fact that imports are plunging because of what's happening on the trade side? And the other part of the equation is this: how do you have positive consumer spending and negative incomes? Is because of that, what they call the K-shape to the economy, the fact that the top 10% are carrying the load. And they're spending their fat equity market gains that they've had. So the personal savings rate has gone from 5% in April to 3.5% right now, which is a huge decline. And so when you're taking a look at that decline in the savings rate, people feeling more and more confident they can spend more of their income because of the pot of gold at the end of the rainbow because of the equity market. And then you tack on to the savings rate coming down to imports declining. And you look at the US economy outside of those two influences, there's been no growth. No growth for the past 3 quarters in the US economy. So I hear it all the time, GDP, 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 but that's because people just don't scratch the surface and look beneath the headlines. Beneath the headlines, it actually is a very weak economy, much weaker than is commonly portrayed. And that's why, if you're asking me the statistic that you will not hear on Fox News and you will not hear coming out of the White House, is the fact that employment growth in the United States is flat as a pancake. If you measure the US economy through the labor force and through organic personal income, you could actually make the argument that the economy is actually contracting right now.
Okay, thanks for sharing that. So Adam, you and Brent, I see you both on X all the time. You're engaging with the crowd and such. I'm just curious in the sentiment that you're seeing from people when you're engaging with folks on social media and just your views on the takes that have been shared so far.
Sure. And I think David nailed it, which is the short answer to your question earlier about why are more hands going up, that the economy is weakening versus strengthening, is this K-shaped economy. You know, it's just math. It's the top half of the K is a minority of people. It's the top 20%. Honestly, it's probably more like the top 15 or 10%. The rest is the bottom half of the K. So just on a numbers basis, I think there's a lot more people who are feeling that this economy is not working for them, for many reasons why David and Nomi just said there. And you know, there's plenty of signs out there, both anecdotal, which is what I hear on social media from real people, that, you know, make you very nervous about where the economy is headed, whether it's been the explosion in delinquencies, which is preceding what should be an explosion in defaults, or a headline I just saw the other day where they're now making it easier to pay your rent on a buy now, pay later program. I shouldn't be laughing at that. It's laughing through the tears. But there are lots of reasons to feel a lot of sympathy for the people for whom, you know, they're feeling increasingly left behind by this economy. And I don't need to tell everybody here about the, you know, the record unaffordability the cost of living has for most Americans now. That being said, I want to raise a counter argument, and I'd actually be very curious to hear the panel's reaction to this, which is, you know, I spend a lot of time listening to the leaders in the new administration, and like them or hate them, they actually are incredibly transparent and like to get on media and explain what they're doing. And if you listen to people like Treasury Secretary Scott Bessent or Commerce Secretary Howard Lutnick, I mean, yes, they're going to be cheerleaders for the administration, but these are serious people who have their own personal brands to risk if they say something's going to happen and it doesn't. And both of them, as well as a number of other members of the administration, are saying, look, we laid a lot of pipe in 2025 to spur economic growth, and that's kicking in, starting really right about now. And, you know, all the provisions in the One Big Beautiful Act, all the tax cuts, all the deregulation, all the foreign capital that's coming in, all the tariff revenue that's coming in, all the new factories and stuff that are being built. They're saying that is going to spur an awful lot of economic growth and eventually jobs growth as we head further into this year. And who knows if all that's going to come to pass, and how much of that is just hot air versus, what's really going to be manifested. But like, there's going to be, I think Scott Bessent was saying, he runs the IRS, it reports up to him at Treasury. There's going to be $150 billion in tax refunds getting mailed out in the next 2 months or so. Like, that is going to be stimulative to the economy. Trump is still talking about sending tariff checks out to households. That is going to be stimulative to the economy, whether you like it or not. And so I do think you ignore the potential of that to, push off the day of reckoning of, any sort of potential recession or anything like that. And so I'm not here cheerleading for the administration. I'm just saying that I personally am beginning to think that, it might not be as all doom and gloom as a lot of people who have been very understandably concerned about the macro data up until now.
Okay, so I've been thinking that what's currently happening is President Trump is trying to buy the midterms.
And I would agree with that. I think he's made it increasingly clear he's going to do whatever it takes. Yeah.
Curious in your thoughts, Brent, on Adam's point that he mentioned.
Yeah, I mean, I think just going back to social media for a second, one of the reasons I like social media is 1 second you could be interacting with David Rosenberg, who's had an incredible career at the highest levels of finance, and the next minute you may be interacting with, David Jones from Kamloops, who's a school teacher. And they may have the same view or they may have dramatically different views, but each are valid, right? And so I find that social media is a fantastic way to kind of take the temperature of what's going on and how people are perceiving things. Regarding Trump and the midterms, yeah, of course he is. Every politician does that. I don't think that's in any way unique to Donald Trump. And one thing I would say is, I think the closer we get to the midterms, the more they will want to do that. And I don't think that they would be horribly offended if there was some kind of a downturn now, because I think they would rather have it now than in August or September or October. So it wouldn't shock me at all to see some volatility over the next 2 or 3 months and then have them react to that and really goose things into the actual election.
Okay, so what role does the future of the Fed play into all of this? So we have, checks are wanting to be cut and everything. Interest rates are desired to be lower and such. And so just curious in your perspective, David, on what role does the Fed play in all of this as well?
Well, I think that we're having the Fed meeting this week. They're on hold. They might be on hold up until Jay Powell leaves in May. But whoever is going to be the next Fed chairman, and whether it's going to be Kevin Hassett, Kevin Morsch, Kevin Costner, whatever, Kevin or...
Which one are you rooting for?
Or Rick Ryder. Well, I think that the best of the lot would be Kevin Morsch, in my opinion, from a purely disciplined standpoint. But you know that whoever it's going to be, Donald Trump, is going to have his thumbprints on the Fed even more than he did before, and he's going to aggressively push for even lower interest rates, whether they're justified or not. Rates in the United States are going to go down. The extent to which that has an impact on the economy is going to rest on whether he cuts interest rates too much and creates higher inflation in the process, which is then going to undercut real incomes. So it's interesting to me that he's campaigning on this big affordability campaign, and yet he wants to cut interest rates, and that could fuel, depending on how far they go, could fuel inflation and undercut everything. It is totally nonsensical. But the one thing that we should know is this, that the Fed is going to be cutting interest rates once Powell's out of the picture, and they could come down very significantly. The yield curve is going to steepen. The US dollar is going to go down and go down by a lot. But you see, the thing is that Donald Trump is trying to buy economic growth, and by buying economic growth through a weaker US dollar is why we're all here. because that's just going to add more fodder to the uptrend that we're seeing in the commodity complex, including precious metals. If you're bullish on gold, Donald Trump's your best friend.
Yeah, that has been proven, for sure. I think gold's over 5,000 right now, right? Yeah, it's over 5,000. I think it had to do with the tariffs on Canada. I think that's what happened. So, Dr. Nomi, what's your perspective on the Fed moving forward? You wrote the book Permanent Distortions. I'm actually reading that, listening to it in the audiobook. You've put a lot of deep research into that. And so I'm curious, what's your perspective on the Fed and what parts of the economy right now and some of these signals, because markets at all-time highs, there's obviously some distortion here. And so just curious in your perspective there.
Yeah, so thanks for bringing that up. The distortion exists between where interest rates are, what the cost of money is, and the value of hard assets. And it's taken several years for hard assets to really meet the moment and surpass it, get gold to 5,000, get silver to, 15,000, kidding, 120 right now, but wherever it's gonna go, have platinum outperform the S&P last year by a factor of 20 to 1 in terms of the upside. So what we're seeing is real assets coming to meet the gap, that distortion between what's been happening with the cost of money and so forth. I agree that the Fed is probably going to maybe do 25 basis points if we get a really bad labor print, so Chairman Powell doesn't feel like he's missing something again. But otherwise, the Fed's going to look for, as is the Treasury Department already, for ways to buy that long end that I agree with you is going to steepen as we cut rates and take some of the balance sheet off of the Fed, which is now running at almost $6 trillion still, which is $1.5 trillion higher than it was after the financial crisis. It's below where it was post-COVID. But what it means is the United States government is spending $1 trillion a year in interest payments. So before President Trump turns on the White House lights, the White House is effectively shelving out $1 trillion a year for that period in interest. And that weakens the economy, it weakens the cost of money, and it strengthens the value, again, why all you are here, of all of these real assets that contribute to the longevity of the actual economy and the actual longevity of personal wealth, of generational wealth, of building something real and substantial.
Okay, thank you. Thank you for sharing that. So looking ahead for the next 12 to 24 months, where do you all see the U.S. dollar headed? And so I want to start with Brent on this one.
Yeah, to be honest, I really don't know over the next 6 months. I'm convinced that Trump wants the dollar to go lower. I don't know that he will necessarily get it. If you think there's going to be a crisis, which I think many people do think that, then 25 years of history says the dollar and crises are 100% correlated and going up. So I have a hard time seeing there being a big crisis and the dollar falling. But if they're able to kind of continue to push their agenda forward and keep the dollar under control, and maybe it goes down to 93, 94, 98, whatever the number is, that wouldn't surprise me at all. But to me, that's the extenuation of the current system. That's what's supposed to happen. That doesn't really cause a lot of problems. What causes problems is when it goes higher and gets away from the central banks. And one thing I would say, and I don't want to spend too much time on it, but I think we're going back to your question about the Fed. I think we are now at a time in history where hard truths are being learned. And I think one of the hardest truths that's going to be learned is that the Fed is not independent. It has never been independent. It's had a lot of autonomy, but that is going to change. And I think in some form or another, the Fed and the Treasury are going to merge functions. I don't necessarily like that, but I think that's where this is headed. And whether that happens this year or over the next 5 years, I don't know. But at the end of the day, a central bank's role is to perpetuate the state, to bail out the system. In a debt-based monetary system, you always have the risk of a collapse. And central banks were created to step in and prevent that collapse. So the idea that the state is going to let the central bank do whatever they want and not do that is to fundamentally misunderstand why they were put there to begin with. So anyway.
If I can just add on that real quick, it is interesting, again, going back to Treasury Secretary Scott Bessent. He is leading the search for the new Fed head, right? So already Treasury is exerting a lot of influence on there. And what's also been interesting about that is he has been really critical about the role of the Fed and is sort of raising some questions about should we rein in some of the Fed's powers here. We'll see if that actually happens or not, but I just find that very validating of what you just said there, Brent.
Well, it's kind of funny. I think there's probably a lot of people in this room who have said in the Fed. I don't know how many people thought that Donald Trump would be the one to replace it.
Yeah, that's a very interesting take. Go ahead, Adam. I'm curious in your perspective on just the nature of the Fed, and from a historical basis, because Brent, you mentioned that the Fed pretty much being in bed with the U.S. government. They're not independent, and so what does this look like historically? Like what typically happens in that type of environment?
Oh, golly, I think it's a better question for Nomi, maybe, or David, than it is for me. But look, end of the day, the Fed is a consortium of banks. It's going to try to do whatever's in the bank's best favor. There may be some more constraints placed around it now by the executive branch than was before. I agree with Brent. I don't think it's ever really been truly independent. I think that's largely been a sham. And so folks who don't know me, my day job is interviewing lots of people the way that Darrell's interviewing us here. And from interviewing people who have actually worked at the Fed, particularly folks like Thomas Honig, who actually sat on the FOMC, he's very transparent. He says, look, we tried to be independent, but there are a lot of voices that speak very loudly, and certainly Capitol Hill and Wall Street speak really loudly and influence, the decision-making around that table. So do I really expect that to change much? No. I just think that maybe it's going to be a little bit more overt that the Fed's going to be jumping more to the executive branch's tune than it's looked like in the past. Let me put it this way, I will say, I think their reaction function is still going to be incredibly fast. So the next time we have some sort of downturn or crisis, the moment it gets beyond some level of acceptable tolerance, they're going to step in super quickly to do whatever it takes. And I do worry that we set a number of precedences in COVID where the genie's out of the bottle, and things like unprecedented amounts of stimulus, will ride to the rescue in a record short period of time, or, we'll do things like direct checks to households again, right?
Dr. Nomi, I want to hear from you as you study the history of the Fed and such, and so what's your perspective on this shift from, the narrative is that the Fed's independent. We had Jerome Powell come out and make some sharp comments about the Trump administration and such, and that's been that battle, and then that's even being talked about at the Supreme Court. And so, curious in your perspective on a historical basis, what does that look like?
Yeah, what's interesting, going back historically, is 13 years before the Fed started, in 1900, the U.S. passed the Gold Standard Act of 1900, and they did that in order to compete with the rest of the world who wanted a secure currency. And so that became gold so they could trade, so they could have something to back them. And so bankers could make loans that had gold backing so they could increase the debt and they could grow the country. What we have now is a massive debt increase without necessarily being connected to growth. And I agree with what Adam was saying about, post-COVID, the Fed's balance sheet blew up from $4.5 trillion to $9 trillion in like 10 minutes. And they can do that. And they are the biggest buyer of U.S. Treasury debt. And so there is that symbiotic relationship. And historically, it's been activated during World War I, during World War II, when there was a reason to repurpose that debt. Right now, the debt is so massive that there isn't enough of a reason to do it. So the Treasury Department is looking at the fact that they need to issue more debt. They don't have a choice. If you look at the budget, look at the deficit, that's just what they're doing. At the same time, they need a buyer of that debt. So I think the symbiotic relationship between the Fed and the Treasury Department is going to continue to exist. The chairperson is nominated by the president. It always has been, and then it's confirmed by a majority of the Senate. That has always happened. So there's always been this relationship, going back to the independence, between who is chairing the Fed, the president that appointed them. The oddity right now is that President Trump happened to have appointed Jerome Powell, and then he decided he didn't like what Jerome Powell was doing for 2 terms. But the term of the Federal Reserve chairperson is very, very long. And so what we will see in May is a switching over to someone that is nominated by him, probably from the Treasury Department or close to the Treasury Department, and that will effectively perpetuate the easing nature of what the Fed needs to do to support the debt in the Treasury Department. And that combination is going to pervade the markets.
Okay, thanks for that context. So as we end this panel, I'm curious in just some brief thoughts on your outlooks for 2026, anything that you think the audience should know. And we can start with you, Dr. Nomi.
I think the dollar is going to go down 5 to 10% because of the rates, because of these debt-related things. I think gold's going to be around 6,000. I think the S&P is going to go up but underperform gold. I see silver at 180. I see platinum around 3,400. I see hard assets continuing to grow. I see the stock market growing because there will be an easing environment, but I see it massively underperforming again, as it did last year.
Okay, how about you, David?
Yeah, I'm just going to use my last minute or so, I think, just addressing something that Adam had mentioned. I don't think anybody in this room should be too impressed about income tax refunds, which it's not something new. We've seen it before. And 150 billion, yeah, Scott Bessent will go for the biggest number in the sky. It's more like $100 billion. And we have a $30 trillion economy. So it's going to add the grand total of 0.3% to GDP. That's where you get for your money. And it's going to have basically a 2 to 3 month impact. If you're an investor in the equity market, for example, there might be reasons you want to be bullish, but you cannot capitalize an income tax refund that is not perpetual, that gives you 2 or 3 months worth of a burst to retail sales. That'll be long forgotten. I think that people talk about the bonus depreciation allowance. What's offsetting that from a capital spending perspective is this heightened level of uncertainty that's freezing the business sector. We talk about a K-shaped economy. Let me give you another K. Last year, volume spending on AI and data centers was 15%. That's strong. Everything else was negative 4% in the business sector. So the AI trade is just basically sucking the oxygen out of the room for what we used to call the old economy. And I'll just say this much, that what we're going to be talking about more post-spring into the summer are the midterm elections. And Donald Trump, his approval ratings, despite what you think he's doing on foreign policy, which a lot of people think is great, the fact that employment is so weak is really draining his approval rating amongst independents. And there's a huge chance, I think it's 80% chance that the House goes to the Democrats. There's a chance now the Senate goes to the Democrats. And we're talking about a lame duck president for the last 2 years. And we'll see how that's going to look. A frustrated Donald Trump, what he's going to try and do is run the government even more through executive order than he did before. And that could be a dangerous thing in its own perspective.
Wow. Okay, Brent, final thoughts?
Yeah, I think, clearly, gold at $5,000 is a bright neon sign saying not everything is great, right? I mean, that's a pretty clear signal. And I think you have to be ready for, volatility. But I would also say, I've been coming to this conference for 15 years now. And at every conference I've come to, there's been a panel that's talked about a potential crisis. And while there have been a couple, markets have gone dramatically higher over that 15 years. And I would just say that the probability that things continue to be okay is not zero. So you don't need to put your entire portfolio into some kind of an Armageddon situation. Have your insurance, be ready for it, but you don't need to go hide on top of a mountain.
Okay, that goes against what I've been doing. I've been buying that fourth turn in ETF.
It's paid off.
I've been buying that fourth turn in ETF, man. Yeah. All right. Go ahead, Adam.
I was trying to remember the ticker for the fourth turning ETF, and I can't at the moment. But pardon me?
Heft.
That's right. So I agree with with what all the panelists said, but just, to Brent's point there about, don't put all your chips on doom for certain in 2026. The one thing we didn't get a chance to talk about at all was valuations, right? Which are,
Insane.
At extreme levels, depending on the metric you use, either historically extreme or at an all-time extreme. All right, and look, we've just had 3 back-to-back-to-back years of basically 20+% returns in the markets. Just statistically, that's really aberrant. To expect a fourth is statistically really improbable. Doesn't mean it couldn't happen. But I'll just say, look, we might get 5+% GDP, in 2026. I know David doesn't think so, and I don't necessarily think so, but that's what the administration's selling. That could happen, and the market could still go down, right? I think for so long they've been so correlated that we just assume, okay, well, however the economy goes, the stock market's going to go, or maybe it's the opposite. However the stock market goes, the economy's going to go. But all I will say is I think to expect another year like we've had in the past 3 years right now is not only statistically improbable, but I think it's somewhat imprudent given where valuations are at the start of the year.
Okay, well, thank you for that doom and gloom outlook.
Can I just say one thing? We have defied,
You got one more doom and gloom point?
Well, yeah, maybe. We have defied the laws of gravity. I finished my comment saying GDP is one statistic that's being juiced by 2 very interesting things. An equity wealth effect on spending, driving the savings rate down, and lower imports. And I keep on hearing about 5% GDP growth, because what Scott Bessent never tells you is what's driving that number. Meanwhile, real incomes in the household sector are going down, and there's no growth in employment. So once again, I feel like I'm listening to Charlie Payne on Fox Business. That's 5% growth. 5% growth in GDP. Okay, sure.
Yeah. Thanks for that anecdote. All right, you all. Well, let's give a round of applause for our
Thanks, Darrell.
panelists.
Thank you.
Thank you all.